Hello, everybody. Welcome to yet again another episode of Forever Slow Stroking the podcast. It's your man, your boy, Eyon, coming to you again, son. I swear, I know. Hit after hit, son. That's all I can say. Hit after hit. Let me get this right. All right, bet. So, we're going to be talking to you. Episode 16. Dang, son, we come a long way. We really came a long way. Episode 16, though. Let's get into it. We're going to talk about implied volatility and volatility. The actual name of this joint is valid volatility. So that's what we're going to call it, valid volatility. And first things first, everybody, please feel free to join the Forever Slow Stroking investing group. It's open for anybody that want to join. All you got to do is hit me up and I'll give you all the details that you need for the group. Also, like and subscribe, you know what I'm saying? If you like the content that you're hearing, and the consistency of it, subscribe, you feel me? Get the alert, you know what I'm saying? Be the first to hear so that way you could prepare yourself for this upcoming, trading week. And also because that allows me to know that I'm doing the right thing. I'm doing good things for y'all and y'all love the content, son. So like it, subscribe to it, and you know what I'm saying? We're going to be valid. So, straight into it. Volatility. Volatility is how much the price of a security or market index fluctuates. It's that simple. It's a lot of definitions out there, and they are very confusing. The definitions really just be like wild. I just be like, son, what does that mean? I don't know, but the best way I can sum it up, it's just the amount of fluctuation in the stock's price. It deals with, for all the engineers and, people that know mathematics like myself, I'm an engineer, it deals with variance and standard deviation. You know what those things mean. You know what they are. You know what variance is. You know what standard deviation is, which tells you the distance that the price is from the average. And also it tells you how wide of a gap it is from the current price and the average price. It's that simple. That's what volatility is. A lot of people are like, oh, this stock is volatile. It's volatile. And you be like, yeah, it is. But you don't know what you're talking about. You don't know why they're saying that. They're saying that because the price moves so much in either direction. It'll either be an uptrend a lot or it'll be a downtrend a lot, but it'll go back and forth. It won't always be downtrending. It won't always be uptrending. So that's kind of insight what it is. And then we're going to move on to what is implied volatility. And this is kind of something I had to study a bit because I was still trying to understand it. And now that I spent, a few hours understanding what implied volatility is, it makes a lot of sense to me. Implied volatility is the market's forecast of a likely movement in the security's price. When I say security, I've told you all this before, but when I say security, I mean like the actual stock, you know what I'm saying? A stock can be a security. A future can be a security as well. It just, you know what I'm saying? That's what the security is. Security, you just call it a stock. You feel me? Bet. So, I'll just say it again. The implied volatility is the market's forecast of a likely movement in a security's price. Typically, you know what I'm saying, it increases, in bearish markets, and then it decreases in bullish markets. And, it's used to price option contracts. A lot of people, want to be valid option traders and things like that. You got to pay attention to the implied volatility, son. It really, really, really helps if you understand the implied volatility. You know what I'm saying? You could trade options more validly. You can really be a valid trader if you know all these things. It's not just knowing, oh, what's the price action on the stock? What does the market think that the stock price is gonna go up to or down to? What are the ranges? You feel me? So it's important, and that's why I'm telling y'all this. You feel me? All right, son. You know me. I gotta give y'all the information, son. You know me. So the high implied volatility, leads to options with higher premiums, and then of course, you'll see that the low implied volatilities it leads to options with lower premiums. Cool. So, and also one thing is you should really consider supply and demand as well as time when you're looking at these what is it called? IVs, which is implied volatilities. When you're looking at these contracts and things like that, you know what I'm saying, along with the IV, you want to look at, what's this supply and demand for this joint? Because if the price is just going up and down, but they don't really have nothing to offer, why? Like, why would I invest into that? Because it could easily go a direction that I didn't expect it to go. You know what I'm saying? So that's another thing. And then also, you want to pay attention to time. How much time left do I have, for this stock price to go to this down to this price or up to this price? You know what I'm saying? Which is, the implied volatility, and I'll explain that to you in a second. With an example. So let me just go ahead and give you the example now, so you kind of be like, oh, all right, that's what Eyon talking about. So, all right, so with the example, you have a implied volatility of what is this, 25%. And mind you, implied volatility is given in percentage. So you have a implied volatility of 25%. And with that, you know what I'm saying, you have a stock, and the stock price is what, $400. That tells me that there's a 68% chance that the stock will either go down $100, because 25% of 400 is 100. So that tells me that, all right, there's a 68% chance that the stock will either go down by $100 or go up by $100. You get what I'm saying? That's how it works. It's really that simple. Like, so, within a year, that price should either be $300 or $500. Son, I'm telling you, son, it's that easy. Like, it's that easy just to catch on to it. And then, of course, you want to use the implied volatility to play options, like I said earlier. So pay attention to that joint. And then when another, helpful piece of information I should give about it. When an asset's future, is difficult to predict, you know what I'm saying? You can't really say, oh, I think the price is going to go here, or the market thinks the price is going to go here. When it's difficult to predict that, you know what I'm saying, that future price, the demand for an insurance on that stock will increase. When people get insurance on the stock, you know what I'm saying, you might hedge your portfolio with it or whatever. So that increase for insurance, you know what I'm saying, the demand for insurance increase, that's what I should say. The result of that demand increase will cause the prices of the option premiums to increase as well. So, son, really, 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 really pay attention to that. You know what I'm saying? When people can't, you know what I'm saying, figure out what's going on, like, oh, whoa, I think it's going here, I think it's going there. I don't know, I can't really call it. That means that there's a lot of, volatility there, and, implied volatility there. You know what I'm saying? So we're going to see, you know what I'm saying, movements in the premiums. The premiums are going to go up. So that's that. It's that easy. And, of course, you know what I'm saying, with that being said, let's get into some hidden gems. And the hidden gem I would like to give is actually volatile stocks to watch. I'm giving you two of them. The first one is LAC. They make lithium batteries. Very important, especially for this EV market that we're in. You wanna invest in and trade companies that are relevant to what's going on. The EV market is going wild these days, son, especially with the whole California talking about banning gasoline sales and all that. So, you know what I'm saying? You might wanna pay a little bit of attention to that joint. LAC is very volatile. Volatile, I should say. And then Workhorse. I made good money off of Workhorse several times, and I really like Workhorse. So yeah. Pay attention to Workhorse, please, because it's very volatile. And I don't know how I keep making money off of Workhorse. You know what I'm saying, on a weekly basis, but I do. I'll trade the stock every week, and I think it's about that time for me to trade it again, really, coming Monday. So we'll see about that. All right, so of course, let's get into, first of all, wow, what a mess. Let's get into this, trading progress for this week, my results. Son, I had a hard week. I had a hard week. I swear I had a hard week. Oh my gosh, I gotta make some corrections. I swear I do. Anyway, let's get into it. So this week, $10 profit on Workhorse, 30% loss on UPS, and then another 38% loss on UPS. $280 profit from Workhorse, $15 profit from FedEx, $20 profit from Neo, $825 in losses from other things that I don't even remember. I just remember how much I lost, son. So yeah. It was that type of week, son. It was a lot of losses, but